Good morning, viewers. Welcome to our audit and assurance forensic lecture. This morning, we will be looking at the topic, the concepts and need for assurance. The concept and need for assurance. And to start with, we shall be defining audit as in the meaning and objectives of audit. An audit may be defined. Audit may be defined as the official examination of the account or accounting system of a company by an auditor. So we see in the definition that the auditor is the one that will come around to examine the account or the accounting system of a company. An auditor is a professional that has been trained and also acquired experience in the field of accounting and auditing. So, the account we are talking here are various in number. For example, in a typical company financial statement, you will see trade payables account, you see trade receivable account, you see bank and cash account, you see payroll, and so on and so forth. So the next thing we shall be discussing is objective of an audit. So when the auditor comes to audit a company's financial statement, what is he out to achieve? So that's what we want to consider now. So the auditor is auditing a company financial statement so that he may form opinion about whether or not the financial statement of the company has been prepared in accordance with applicable financial reporting standard. And so what are those applicable financial reporting standard? Applicable financial reporting standard are made up primarily of applicable financial reporting framework. Whether they have been prepared in accordance with applicable financial reporting framework. So the framework in question is made up of A, legislation, and B, accounting standard. E.g., international accounting standard or international financial reporting standard. So now, next thing you want to look at is the concept of stewardship agency and accountability. So we see the reason why an audit is necessary in the first instance is because the ownership and the management of a company are separated, particularly in large companies. The shareholders are the owners of the company. Shareholders are the owner of the company, while the companies is controlled and managed by the directors. So in order to be sure that the directors are acting in their best interest, that's why the need to engage an auditor is necessary. So provide opinion on work of directors. So when we are talking of stewardship, the directors here manage the company's assets on behalf of the director, and they are expected to act in the best interest of the directors. Also, when you look at the legal principle of agency, the director also acts as an agent to the shareholder who happen to be the principal in this instance, and they are expected to act in the best interest of the shareholder. So the relationship between these three parties can be represented in the diagram below. We have the directors, who are the managers, and we have the shareholders here, who are the owners. Now these directors have to put a mechanism in place through which they will be reporting to the shareholders, and that mechanism is the financial statement that is being prepared by them. So this financial statement is an accountability document through which the directors are accountable to the shareholder, but the shareholder have to put somebody in place to be watching over the shoulder of the directors in order to ensure their interest is best protected, and that is where the auditor comes in. So the auditor prepare audit report. Auditors report, and this add credibility. It add credibility to the work that has been done by the director. So next thing that we're considering is elements of an assurance engagement. Elements of an assurance engagement. Before we go into that, let us even look at the meaning of assurance. The meaning of assurance. Assurance means confidence. Assurance It means confidence. And assurance can be provided by both audit or review. And that will bring us to level of assurance. Levels of assurance. First, we have A, reasonable assurance, and B, we have limited assurance. So in a reasonable assurance, the auditor will just say, based on the audit he has carried out, so he has reasonable assurance that the financial statement show a true and fair view. But in the case of limited assurance, he will say, based on his audit, there is nothing that comes to his attention, or based on his review, that causes him to believe that the financial statements are misstated. So this one can be termed as positive assurance, and this one is negative form of an assurance. So we now have elements of an assurance engagement. 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 In an assurance engagement, we have 5 basic elements, and the first one is a 3-party relationship. Comprising of number 1, the practitioner. The practitioner is the professional or the accountant that will review the subject matter prepared by the responsible party and provide an opinion on it. Then we also have the responsible party. Responsible party. This one is accountant / auditor. This one is the director of management. Management, they are the one that prepare the subject matter, which could be a financial statement and it could be a cash flow forecast, depending on the situation. Then we have the third one is the intended users. Intended users. In the statutory audit, this will be the shareholders. They are the ones that use the information that is audited or reviewed by the auditor. The number 2 here, we have the subject matter. The subject matter. So it is the data that is being prepared by the responsible party and reviewed or audited by the practitioner and submitted to the shareholder for approval. So here it could be financial statement, or it could be the cash flow forecast. Then number 3, we have the suitable criteria. These are rules against which the subject matter are evaluated. For example, in Nigeria, We have Kama 2020, that is Company and Allied Act 2020. We have Bofia 2020, Bank and Other Financial Institution Act of 2020. Then we also have FRCN, Financial Reporting Council of Nigeria Act 2011. So they are the rules against which the subject matter will be evaluated. Then the third one is evidence. Third one is evidence. Evidence is all information that the practitioner will gather on which he form base the conclusion on which he form his audit opinion. Information gathered by the practitioner. Information used by the practitioner to arrive at the conclusion on which he base his opinion. So then the last one is assurance report. Assurance report. So this is the report that the practitioner will prepare at the end of his audit, in which he will state his opinion as to whether the subject matter show a true and fair view, and that he has been prepared in accordance with the applicable financial reporting framework. So thank you very much for watching. See you in our next video.